Warren Buffett, 11 mistakes every investor make, but you shouldn't. Who hasn't heard of Warren Buffett? One of the world's richest people, consistently ranking high on Forbes' list of billionaires. His net worth was listed at $100 billion as of June 2022. Buffett, known as the Oracle of Omaha, is the most successful and respected investor in the world history. This is why it's not surprising that Warren Buffett's investment strategy has reached mythical proportions. Buffett follows several important principles and an investment philosophy that interests people around the globe. So, what are his secrets? In today's video, we'll look into important mistakes that almost all investors make according to Warren Buffett. Mistakes that you should avoid by all means. Before we start, make sure you hit the like and subscribe button to help us make more videos for you. And don't forget to press the bell icon to never miss a video. So, let's jump right into it. Number 1. Timing the market. The biggest mistakes investors all over the world make is trying to predict the market and trying to catch the bottom and the peaks, what is called timing the market. According to Buffett, it is very difficult and almost impossible. Trying to predict what happens on a macro level in the economy is so alluring. Warren Buffett says that investors should only focus on two things in life: the important and the knowable. Where the market is heading is important, but is it knowable? Buffett simply recommends identifying superior companies and buying them at a fair price. The tide of the ocean can both rise and sink all ships. Recognizing that a ship is superior is a lot easier than predicting the storm. Number 2. Omissions. Warren Buffett says the next biggest mistake we make is making omissions rather than commissions. Omissions mean you avoid doing something you could and should do. The mistakes that we discussed before were mistakes of commission. We do something to commit those mistakes. But this mistake involves doing nothing. If you don't do anything, you don't take action. You do not take risk. But then you do not get a reward, meaning you don't get rich. So not investing is a big mistake according to Warren Buffett. Number 3. Using a lot of leverage. Warren Buffett once said, "There's only 3 ways that a smart person can go broke: liquor, ladies, and leverage." According to Warren Buffett, using a lot of leverage is one of those mistakes that investors often make. Investing is not a game for impatience, and nothing screams more desperation as a portfolio full of borrowed money. Using leverage is the financial equivalent of playing Russian roulette. There is a fairly good chance that you're going to lose everything. Warren Buffett doesn't recommend to put your hard-earned money at risk. Number 4. Missing the forest for the trees. Many investors spend hours making financial decisions and focusing on rather small details, but according to Warren Buffett, they miss the forest for the trees. Warren Buffett makes an evaluation of the investment opportunity in 15 minutes after knowing the price, the management, and the future trends of the industry. It's not because he is very experienced, but because he likes to keep things simple. So if you as an investor get these 3 things right, you don't need to be worried about every detail of the business. Number 5. Getting attached to your purchase price. According to Warren Buffett, businesses treat all of their investors the same way, with no difference for the price each of them had paid for their shares. Look at this graph of Amazon's share price over the last few years. Let's say there's a person named Adam who purchased the shares in June 2022. He has now made a 5% return on his investment. That's cool for him. And another person, Bob, purchased the company in July 2021. And during this course of time, he has lost 38% of his investment. It sounds terrible. And there is a third investor, Jenny, who invested in Amazon almost 5 years ago. She has earned a 133% return in total. Well, now all this doesn't matter because they purchased Amazon at different times, and Amazon doesn't care about your purchase price. they don't have empathy for their investors. They treat investors who have lost 38% and earn more than 100% in the same way. The only thing that matters for today's decision if one should sell or keep Amazon is how the company is likely to perform in the future. That means that if Amazon goes up 50% more in a year, Adam, Bob, and Jenny will all make a 50% profit from today's level. Number 6. Aggressive growth projection. Many companies with high stock market valuations try to defend their share price by forecasting astonishing growth. But as Buffett points out, expecting very high growth rates is a mistake. He actually recommends to stay away from growing companies and instead suggest investing in value companies that might grow, especially if they can do that without needing too much capital. The Oracle of Omaha claims that growth at any price, which has been the mentality of Wall Street during these times of low interest rates, is a huge trap. Number 7. Jumping over a 7-foot bar. Climbing impossible heights or jumping over mountains can sometimes have terrible outcomes. The same happens in the investment world. Investors make decisions based on their limited knowledge, thinking that they are going to make more money, but in fact, everything goes wrong. Warren Buffett strongly advocates investing only in business people understand and have some expertise on. He says that everywhere you are rewarded for doing the difficult things, but in the investment world, you lose money if you are not an expert. Number 8. Confirmation bias. For investors, confirmation bias is a particularly dangerous thing. Once an investor starts to like a company, he may dismiss negative information as irrelevant or inaccurate. Investors often stick with a declining stock far longer than they should because they interpret every bit of news about the company in a way that favors the company and even seek out information that supports their case. Mr. Buffett recommends to avoid making bad decisions by doing 2 things. Be aware of the danger of confirmation bias and acknowledge that our judgment can be influenced by it, and actively seek out and understand information that disagrees with our existing belief. This can help investors to stay as objective as possible and not to lose their money. Number 9. Staying active all the time. Who do you think is most likely to succeed? A tennis player who plays 5 games a day or the one who plays 10 games per year? The answer is obvious, the one that plays 5 times a day. Which investor is likely to make more money? The one who buys 5 stocks per week or the one who buys 5 stocks per year? The one who buys 5 stocks per year. Warren Buffett says that investing is one of those rare exceptions where inaction is rewarded. You can't buy an equivalent of a Coca-Cola at a fair price every day. It just doesn't work that way. If you are too active and trade too often, the chance you lose is much higher. So, be patient. Number 10. Diversifying too much. According to most experts, diversifying your portfolio is a good idea. But Warren Buffett says that investing in more and more businesses puts you in the red because you can't focus on everything and you start making wrong financial decisions. That's why he says that you shouldn't invest in more than 6 businesses. If you just focus on these 6, you can have a good overview, make wiser investment decisions, and eventually grow rich. Number 11. Following the herd. In many things in life, it pays to listen to the crowd, and people tend to do so. They get fearful when other people are fearful. They get excited when all around them are excited. If a lot of people like a particular movie, there's a good chance that you'll enjoy it too. But if all your friends are enthusiastic about one particular stock, it probably means that you should not buy it. Why? It's because there's no such thing as a good idea, regardless of price. Maybe a particular business can look very promising and somebody has already got rich on it, but it's not necessarily going to be a good investment for you, since future success of that business is already reflected in a price. Warren Buffett recommends once again to develop your knowledge and competence about the business you're going to invest in and not base your decisions just on following the crowd. So, that's all for today's video. Hope avoiding these mistakes can help you to save a lot of money and invest them wisely in Warren Buffett style. For more videos, subscribe to this channel, press the bell icon, and share your thoughts by commenting below this video. We'll be back to you soon with another amazing video.